Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. Trump's America First deals are taking shape, with the deadline now passed for countries to make deals. Still, no hyperinflation. About 40 countries did make deals, covering nearly half of imports. It's actually two-thirds of imports outside NAFTA or USMCA, which mandates zero tariffs on about half of Mexico and Canada imports, unless Trump wants to throw away the agreement, which he might. The big holdout is China. For now, they're paying 30% on a temporary truce. So with that, where do we stand? So far, deals have been grotesquely in America's favor, as it should be, considering our market is much more important to them. So Japan, Korea, and the EU now have to pay 15% tariffs on almost everything they send, with zero tariffs on American goods, while opening vast swaths of their markets to American goods, including cars, agricultural products, and energy exports, in case you want to stomp around Paris in that Ford 350. The three also agreed to invest $2.25 trillion into the American economy. For perspective, that's over half of current total annual investment. The UK and Australia got friend prices of 10% for most goods without the investment requirements. Southeast Asians like Vietnam and Thailand got rates of 19 or 20% with promises to buy U.S. goods. So Indonesia agreed to buy $25 billion, including 50 Boeing jets. At least somebody's buying them. The Asians are also paying 40% on Chinese transshipments, which were using them as tariff laundering platforms. A few countries got whacked. India got 50% as punishment for importing massive quantities of cheap Russian oil to go with the Iranian oil they've been importing since Carter. Brazil also got whacked at 50% because their Supreme Court stole the last election for the communists and is prosecuting populist Bolsonaro, Brazil's Trump, for allegedly trying to overthrow the state when his supporters protested the rigged election, so Jan 6 if Kamala had won. This all leaves roughly 150 countries without deals. They get tariffs between 10% if they already import a lot from us, up to 41% if they do not. As for the holdouts, China is bleeding out and dumping products at a loss, so they'll have to come to the table. For Canada and Mexico, Trump is threatening to hit them at 30 or 35%, so it could get rough in Ontario and Chihuahua. So what's next? Since Trump kicked off the trade war, tariffs have been all over the place. Sometimes nothing, sometimes 100%. Now that they're written down, companies can start making plans, whether that's price hikes or moving production to the U.S. inside Trump's big, beautiful tariff umbrella. In the coming months, we'll probably see a bit of both, though it won't move the needle very much. Even tariff-phobic Federal Reserve pegs total tariff inflation under 1%, while factories take a long time to plan and build, so those jobs will not be here until 2026 or 27. The biggest surprise is how much leverage America's had all these years that we never used. Trump is finally using it, and it'll be hard for future presidents to throw away. So for the rest of the world, this is the new normal. Net migration just went negative for the first time in 50 years. Shockingly, the fruit is still getting picked, the houses are still getting built, America's lawns have not reabsorbed civilization. The news comes from CNN, who actually sells it short. According to the Committee on National Statistics, the last time migration was negative was 1945, as in the boys came home from Europe and wanted their jobs back. This is quite a turnaround from Biden. Last year, according to the Census Bureau, net migration was plus 2.8 million, which is more than the population of Nebraska. Of course, it may be much higher since known criminals presumably did not check in with Officer Bob. The main driver, of course, was closing the border. Border encounters, so people caught trying to sneak in, are down 97%. A year and a half ago under Biden, we had 250,000 encounters per month. Border encounters, people trying to sneak in, are down 97%. A year and a half ago under Biden, we had 250,000 encounters per month. That's down to just 141 per day on a 2,000-mile border, so that's one every 14 miles. More important, migrants are actually getting arrested. Instead of getting a free bus ticket and a prepaid MasterCard, for the third month in a row, there have been 0 illegals released into the country. The other side of it, of course, is deportations, voluntary or otherwise. ICE is up to 25,000 deportations per month, but voluntary self-deportations are at least 5 times that, bringing it close to 200,000 per month leaving. This is all doing amazing things to the economy. According to the BLS, since Trump took office, foreign-born employment is down 1.1 million, while native-born employment is up 2.5 million. As in, Americans will do the jobs, just not for peanuts. This, too, is quite a turnaround from Biden, during which almost half of all jobs went to foreign-born workers at the expense of Americans. Finally, wages just hit a 60-year high as those companies discover they actually have to pay living wages. So far, Trump's been going after the 15 million plus illegals, but that is only half of migration. There's another 3 million asylum seekers, at least 500,000 so-called refugees, so-called because many leapfrogged from country to country till they got here, which would make them economic migrants. Then there's the nearly 750,000 H-1Bs who are overwhelmingly low-wage IT and orderlies, not the top-shelf talent the program was supposed to be. Plus, of course, 13 million green card holders, many of whom are former H-1Bs who get automatic green cards if they stick around long enough. So that could bring the H-1B number to nearly 3 million. So what's next? Mass migration has been a bonanza for the uniparty that's wiped out blue collars. For Democrats, it turned entire states blue, like California, which elected Nixon and Reagan. For Republicans, it kept their donors knee-deep in third-world labor. There's a lot more work to do, and it would go faster if Obama judges would get out of the way, but it is a great start. A word from our sponsor. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington. The inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold paid in more ounces of gold. You retain ownership of real, allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. Now back to our show. Republicans want to replace the mortgage industry with a Wall Street bailout machine that would recreate the 2008 crisis with bigger trillions. What could go wrong? Last week, Trump floated privatizing Fannie Mae and Freddie Mac, two largely government-owned companies that buy and guarantee 2/3 of the mortgages in America. Trump wants to sell these off to investors, which sounds good at first blush. Taxpayers should not be owning mortgages. But the problem is they would be privatized with the taxpayer bailout guarantees. As the Wall Street Journal put it, this is, quote, unchaining the monsters to expand risk at taxpayer expense, adding, quote, Americans have seen this horror movie before and it did not end well. Now, privatization with guarantees would be a $355 billion gift to shareholders, but they need the guarantees because otherwise Fannie and Freddy are worth less than a Blockbuster gift card. So how did the federal government put taxpayers on the hook for 2/3 of mortgages? It started in 1938 when FDR created Fannie Mae to bail out banks' mortgage books. Freddie was added in 1970 to bail out savings and loan mortgage books. It's a big club and you ain't in it. Both were privatized in the 80s and managed to keep their nose clean for about a decade, sticking with high-quality prime mortgages with full documentation and decent credit. But in the early 2000s, they did what anybody with a taxpayer bailout does. They went crazy on the risk. Now, it's an iron law of finance that more risk equals more profit. You can charge more for a risky loan. And it's free money when the taxpayers are eating the loss. So Fannie and Freddie jumped into subprime mortgages with both feet, lending to people with no jobs, no income, no documents. Since subprime's risky, they could charge more. By the eve of the crisis, Fannie and Freddie accounted for nearly half of all mortgages in the country. Most were bundled into so-called mortgage-backed securities, where you toss a bunch of loans into a single bond and sell it to insurance companies or pension funds. It's a great way to launder crappy loans. You've made sausages with no-doc loans, and now grandma's pension is on the hook, so you're guaranteed a government bailout. When the crash came, Fannie and Freddie cashed in on a $191 billion bailout. Today, that's between $300 and $400 billion. So obviously, let's do it again. So what's next? The federal government should be out of the mortgage business, but without government guarantees and standing bailouts. The wider problem is our entire financial system survives only because of federal bailouts. From Wall Street bankers with the Fed and Treasury on speed dial to the Fannie and Freddy holding mortgages hostage. We should be doing what we can to untangle these bailouts, not bake them in with $355 billion investor handouts. Here comes the student loan tsunami with an estimated 9.7 million borrowers in delinquency for more than $250 billion in loan balances. Perhaps Joe Biden letting balances run for 4 years to buy votes was a bad idea. Last week, the New York Fed issued their quarterly report on household debt. It's up, of course, to the tune of $185 billion in just 3 months, bringing household debt to $18.4 trillion, up $4.5 trillion since COVID. Now that's funny because in COVID they handed out $4.5 trillion in stimmies and so-called relief, yet debt went up by almost precisely that same amount. Debt grew across the board. Mortgage balances grew by $131 billion to $13 trillion. HELOCs rose 10% annualized to $400 billion as Americans raid the piggy bank of home equity. Credit cards hit $1.2 trillion, up 6% on a year ago. Notably, incomes have not grown 6%, meaning credit cards continue eating American consumers alive, with rates that, thanks to Jerome Powell's interest rates, are over 24%, which, to be fair, is lower than the mafia. In fact, credit card delinquencies are now higher than they were just before the 2008 crisis. Auto loans jumped to $1.7 trillion. Other debt, like retail cards, hit $540 billion. Notably, credit scores on both are declining, as in car makers are getting desperate and lending to deadbeats just like they did in 2008. But the real shocker was student loans, not the amount, which crawled up to $1.6 trillion, but the delinquencies, which jumped to 1 in 6 loans. Among student loan borrowers over age 50, this is closer to 1 in 5 who are not paying. This is nearly twice the historical rate of delinquency on student loans, which are surprisingly one of the most deadbeat loan categories, even worse than credit cards. So yes, millions of deadbeats are going to college on your dime. Now, none of this matters yet because it takes a few months for delinquencies to start registering as actual defaults. At that point, borrowers have 2 options. Take the default and ruin their credit. Considering student loan is not dischargeable in bankruptcy, this is a permanent gaping wound that shuts them out of ever buying a house or even a car. So they won't do that. Instead, they'll have to start actually paying their bills, starving their budgets for avocado toast and those self-care spa weekends in the Hamptons. This would hit consumer spending to the tune of $63 billion, good for a quarter point on GDP, and worth maybe a third of a point of lower prices as billions go from chasing goods to paying debt. So what's next? All through Biden, student loan pauses were a shadow stimulus on the economy, boosting consumer spending while the debt piled up in the dark. Now, the piper is coming for his pay. Near-term, millions of deadbeats will have to cut back on spending. Long-term, the solution is fewer loans. Federal loans should only go to majors that actually can pay it back, so engineering, medicine, vo-tech, and trades. This would bring down college costs because schools don't build dorms with lazy rivers if students have to cover tuition working at Olive Garden. The Big Beautiful Bill actually nudged on this, consolidating sweetheart payment programs to cut maybe 5% off the student loan taxpayer hit. But it'll take a lot more to end what's become a universal basic income for the left's university motherships, while sentencing millions of Americans to a lifetime of debt slavery. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada and they're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. Donald Trump is going all in on artificial intelligence to ensure the industry can grow without deep state control while ensuring America continues dominating what is easily the most important technology in our lifetimes, and the most dangerous if the American government or the Chinese government captures it. Back in January, just 3 days into office, Trump issued an executive order directing federal agencies to come up with ways to, quote, sustain and advance America's AI dominance. The order focused on 3 areas: permitting data centers, which are the backbone of AI and need a lot of energy, preventing, quote, woke AI in the federal government, which pretty strongly discourages it everywhere, and ensuring America keeps our worldwide dominance in AI, including in military applications. On July 23rd, the White House issued a 26-page report fleshing these out. Probably the most important is removing red tape, so allowing for AI regulatory sandboxes and limiting state regulation the way we did with the early internet. This is a big reason why America dominates the internet. Unlike manufacturing, where American companies are crippled with green and labor regulation, up until the Patriot Act, the internet was pretty much one giant sandbox. Trump's hands-off approach is in stark contrast to the Biden administration, which effectively wanted a licensing regime for AI, so it censors and gaslights as a government-managed cartel. Tech pioneer Mark Andreessen called this, quote, absolutely horrifying, warning that government-captured AI censorship would be, quote, 1,000,000 times more dangerous than social media. The other 2 pillars of the new report are mandating federal procurement, including the DoD, only from, quote, ideologically neutral AI, which should nudge AI models to reduce their blatant ideological bias, along with easing restrictions on data centers and the enormous energy and water infrastructure they need. This last is important because Europe is fundamentally crippled in AI because of their insane green rules. But China is not. If AI needs it, they'll drop a dozen coal plants or a canal. In other words, without energy and water, we literally hand the industry to China so it can impose that censorship regime on the entire world while running circles around the U.S. military. This all matters because AI is growing much faster than cheerleaders expected even a few years ago. AI is now 71% of all venture capital in the U.S., running over $300 billion annualized. At this stage of the internet, so call it 1997, internet VC was just $3.5 billion inflation adjusted. So AI is roughly 80 times the internet. Goldman forecasts AI could increase real economic growth by 50% over the coming decade. Prominent MIT growth economist Darren Acemoglu thinks it could double productivity growth. Currently, according to Forbes, 64% of businesses plan to boost AI spending. McKinsey projects $4.4 trillion in productivity gains. That's almost 1/5 of the entire economy. Now, all this is going to do a number on jobs, especially white-collared cubicle jobs, suggesting it is very important to remove red tape on the rest of the economy so new jobs, gigs, and hustles sprout up to catch the layoffs. But AI is coming either way. 80 internets is a heck of a number. And if we don't build it in America, China is chomping at the bit. So what's next? On AI, we are at an inflection point comparable to the 1990s internet, where Washington can either let it run or capture it. Bill Clinton, to his credit, let the internet run. Happily, Trump wants to do the same with AI. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.